Are you struggling to pass the CPA exam? Did your review course fail to fit your learning style? I'm Darius Clark of I-75 CPA Review, the #1 course supplement, where the right teacher makes all the difference. And if you failed FAR, you probably received something from the AICPA that looks like this. And the more it says weaker in these content areas, the more concepts you really need to work on. And the problem is, if you don't improve in these content areas, you will likely get a lower score on your next attempt at FAR. And we certainly don't want that to happen. So let's take a look at some must-know multiple choice questions for FAR and improve on your concept understanding at the same time. And this first question is going to be about leases, and that's from Section 3, Select Transactions. On December 31st, year 18, C Corp leased equipment from SOAR for 10 years. The lease expires December 31st, year 28. Annual payments of $50,000 are due when? December 31st, and the first payment is made at lease inception. So that means annuity due. The present value at lease inception, discounted at 10%, they give us $337,950. The lease is appropriately accounted for by C Corp as a finance lease. In its December 31st, year 19 balance sheet, C Corp should report a lease liability of how much? So they want the lease liability at the end of year 19. The lease actually started at the end of year 18 with an immediate first payment at December 31st, year 18, but they don't want year 18's lease balance, they want year 19's lease balance. Well, the initial payment of $50,000 made on December 31st, year 18 was all principal. No interest yet, because interest requires time, and no time has elapsed. So just take $50,000 off the original $337,950, and if they would have asked for the lease liability at December 31st, year 18 after the immediate first payment, you would have said $287,950. But don't pick letter C there because they want to know 1 year later, December 31st, year 19, the second lease payment is made. But 10% of the balance of $287,950 represents interest. So out of the $50,000, $28,795 is interest. Only the other portion that doesn't represent interest is principal reduction, and that's $21,205. So subtract $21,205 from $287,950, and there's your lease liability after the second lease payment on December 31st, year 19, $266,745. And this is exactly the kind of question you got to be ready for. Now, you know you're going to see leases on the exam. Could you have answered that question 5 minutes ago? What about when you see it next time? This next question is going to be on investments. And this is from Section 2, Select Financial Statement Accounts. And all of these questions are right out of the I-75 test bank. Laney Corp purchases shares in Nora Corp for $500,000 in August of year 1. By December 31st, year 1, the value of the shares have increased. Laney Corp would increase the investment account for the increase in market price if Laney Corp was accounting for the investment using the fair value method. Yes, because you do a mark to market at year end, and the increase in value would be reflected in the investment account. You would debit the asset, credit a gain on the income statement. But under the equity method, you would not do that because we don't have a mark to market adjustment under the equity method. Instead, we pick up the income from investee on the income statement, which increases the investment account for that same amount, and then we reduce the investment account for any dividends received. But we don't do a mark to market under the equity method. Meadows Corp had pre-tax book income of $150,000 in year 1. Temporary differences included depreciation for tax purposes in excess of book depreciation, DTL, of $10,000, warranty expenses that are not tax deductible yet, DTA, $4,000. How much is current tax expense for year 1? So not deferred, current, assuming a 21% tax rate in the current year and a 25% rate in future years. We don't care what the rate is in future years because they're not asking for deferred tax. They're only asking for current. So our job is to calculate taxable income for this current year. Start with book income, $150,000, and then excess depreciation for tax purposes, means that an additional $10,000 can be subtracted from book income to arrive at taxable income. We're down to $140,000 right now. 150 minus 10. Then warranty expenses that are not tax deductible yet, but they've been expensed on the books. So add back 4,000 and we're at 144. Now multiply by the 20% current rate and you'll get your current tax expense of $30,240. Bryan Corp uses the double declining balance method of depreciation. They purchased an asset on January 1st, year 1 for $420,000. The machine has an estimated useful life of 6 years, salvage value of $60,000. The net book value on December 31st, year 2, end of the second year is how much? So double declining balance, that's twice the straight line rate. Straight line for a 6-year life would be 1/6 per year. Therefore, if we're going to double the straight line rate, use 2/6 for double declining balance. But do not subtract salvage value when you start to depreciate using double declining balance. Although the question asks for December 31st, year 2 book value, year 1 depreciation needs to be computed first whenever you use double declining balance. So let's start with year 1 depreciation. 420,000 times 2/6 equals 140,000 for year 1 depreciation, but they didn't ask for that, right? But subtract the 140,000 from the balance of 420, and the declining balance going into year 2 is 280,000. That's an important step because now you know the balance to calculate depreciation on for year 2. It's 280,000 times 2/6 again. And that's 93,333. And that's not the answer because they don't want depreciation expense for year 2. They want the book value at the end of year 2. So you'd have to subtract 93,333 from 280,000 and your book value is 186,667. So if you failed FAR and you want to pass next time, go to cpaexamtutoring.com and get yourself on I-75, where the right teacher makes all the difference.